Every successful business depends on accurate financial information, and every accurate financial record begins with one essential concept: the accounting equation. In this video, you'll learn the accounting equation in the simplest way possible. How the accounting equation actually works. The accounting equation works because every resource owned by a business has a financial source behind it. Imagine starting a business by investing your own money. As soon as that money enters the business bank account, it becomes a business asset. At the same time, the business recognizes that the owner has invested funds into the company, creating owner's equity. If the business later borrows money from a bank, cash increases, but so does the amount the business owes, creating a liability. Every financial transaction affects at least two accounts, ensuring that the equation always remains balanced. This is the reason accountants use the double-entry accounting system. Instead of recording only one side of a transaction, accounting records both the resource received and its source. As businesses grow by buying inventory, paying expenses, earning revenue, or repaying loans, the accounting equation continues to balance, providing an accurate picture of the company's financial position. Understanding assets, liabilities, and equity. The accounting equation is built around three important components: assets, liabilities, and equity. Assets are everything a business owns or controls that has value and can provide future economic benefits. Examples include cash, inventory, equipment, computers, vehicles, buildings, and money owed by customers. Liabilities represent everything the business owes to outside parties, such as bank loans, supplier invoices, taxes payable, wages payable, and business credit card balances. These obligations must eventually be paid. Equity represents the owner's financial interest in the business. It includes the money owners invest, along with profits that remain inside the company after expenses have been paid. As the business becomes more profitable, equity generally increases, while owner withdrawals reduce it. Together, these three categories describe the complete financial position of a business. Understanding how they relate to one another is essential because every accounting transaction affects one or more of these components while keeping the accounting equation in perfect balance. The accounting equation explained. The accounting equation is written as assets equals liabilities plus equity. Although it looks like a simple mathematical formula, it represents the financial structure of every business. The left side of the equation shows everything the business owns, while the right side shows who has a claim on those assets. Those claims come from two sources: creditors who have loaned money to the business, represented by liabilities, and the owners who have invested their own money or retained profits, represented by equity. The accounting equation must always remain balanced because every business transaction affects at least two accounts. For example, purchasing equipment with cash decreases one asset while increasing another, leaving total assets unchanged. Borrowing money increases both cash and liabilities. No matter what transaction occurs, the accounting equation remains in balance when recorded correctly. This principle is the foundation of the double-entry accounting system used by businesses around the world. Understanding the balance sheet. The balance sheet is one of the most important financial statements because it is built directly from the accounting equation. It provides a snapshot of a business's financial position at a specific point in time by listing its assets, liabilities, and equity. On the left side of the balance sheet, you will find everything the business owns, including cash, inventory, equipment, and other valuable resources. On the right side, you will see liabilities and equity, which explain how those assets were financed. If the accounting records are correct, both sides of the balance sheet will always be equal. This is why it is called a balance sheet. Business owners, investors, lenders, and financial analysts use the balance sheet to evaluate a company's financial strength, liquidity, and overall stability. By reviewing this statement, they can quickly determine what the business owns, what it owes, and how much value belongs to its owners. Real-life accounting equation examples. Let's see how the accounting equation works in a real business. Imagine you start a business by investing $10,000 of your own money. The business now has $10,000 in cash, which is an asset, and $10,000 in owner's equity, so the equation is balanced. Next, the business purchases $3,000 of inventory using cash. Cash decreases by $3,000, while inventory increases by $3,000. Both are assets, so total assets remain unchanged. A few days later, the business borrows $5,000 from a bank. Cash increases by $5,000, and liabilities also increase by $5,000. Finally, the business sells inventory for a profit. Cash increases, inventory decreases, and the profit increases retained earnings, which is part of equity. Every transaction changes the financial records, but the accounting equation always remains balanced. This is exactly how accountants record thousands of transactions every day while maintaining accurate financial statements. Key takeaways and quick recap. Let's quickly review the most important points from this lesson. The accounting equation is the foundation of accounting because it explains the relationship between a company's assets, liabilities, and equity. Assets represent everything the business owns. Liabilities represent everything the business owes, and equity represents the owner's financial interest in the company. The accounting equation is written as assets equals liabilities plus equity, and it must always remain balanced regardless of how many transactions occur. Every correctly recorded transaction affects at least two accounts, which is why businesses use the double entry accounting system. The balance sheet is built directly from this equation and provides a snapshot of the company's financial position at a specific point in time. Once you understand this relationship, many other accounting topics become much easier because they all connect back to this one simple but powerful financial principle. Best accounting book for absolute beginners. If you want to strengthen your understanding of accounting after watching this video, reading a beginner-friendly accounting book is a great next step. Look for a book that explains accounting concepts using simple language, practical business examples, and easy-to-follow illustrations instead of technical jargon. A good beginner's book should cover topics such as the accounting equation, bookkeeping, journal entries, financial statements, debits and credits, and basic financial analysis in a logical order. If you found this video helpful, then like, share, and subscribe this channel to get future videos. Thank you for watching this video.